So welcome to this workshop. We are really grateful that David Madara from OceanPoint Insurance is joining us. I'm sure most of you have seen that there have been a lot of increases in costs in every part of your work, but the insurance industry is definitely seeing that as well. So we're grateful that David has made the time to join us and to give you some suggestions about how you can manage those costs moving forward. So we have a small enough group that feel free to unmute yourself at any point to ask questions. You can also put questions in the chat, but it's just as easy for you to unmute yourself and to ask a question. David has welcomed that throughout the presentation. So feel free to make this an interactive session. And without further ado, I will turn it over to David.
Great. Thank you very much, Nancy. I appreciate it. Appreciate the opportunity to work for Grantmakers Council. And it's always wonderful to be in the same room with nonprofit folks. I have been doing the insurance gig, representing clients for about 35 years, and probably the last 2 decades of that has been focused on the nonprofit sector. I don't know whether that was because I was born into a household where my parents all left the house at 7 o'clock for board of directors meetings for different community organizations, or being a Boy Scout, or all of the above. But I love working for mission-based organizations, and recognizing that as I recognize the squeeze and the challenge that mission-based organizations are to deliver it. The squeeze of resources, whether that is people, time, expertise, and money. And today we're going to focus on the money side of your insurance. We're going to talk about how do you manage your insurance costs? How do you communicate your insurance issues with your constituency? We have a great group. We should have about 20 folks online here today that range from organizations that serve folks in the arts community, the Latino community, women's community, students, animals, rights, music, hunger, farming, immigration, open space, legal, and the arts. So we have a very broad sector. So I'm very much looking forward to that. And please, as Nancy indicated, don't hesitate to unmute. We have a small group. Unmute yourself if there's something. My talk today is going to be relatively high level, meaning I want to just give you the tools to start and embrace the management of your insurance costs. Feel free to give me a call for the details later. But today is kind of the down and dirty that I hope you can walk away from today and say, hey, I need to attack that. I need to make a phone call to my broker. I need to get those files in order. So looking at what we're going to cover as an overview, how are your premiums developed? Where do they come from? What affects those? What can you control? How do you control those costs? By controlling risk. You're going to hear me talk a lot about risk and risk management. The importance of best practices. Best practices meaning, are you doing things right? Do you have it documented? Do you have policies and procedures in place, and the why that's important? Shopping. Okay, am I paying the right price? My costs are going up, but is this reflective of the marketplace? Do I have another choice? So we're going to talk a little bit about strategies for shopping. And then where do I spend my money? Amongst all the coverages that I have, how do I prioritize them? A concept called total cost of risk, which is really just a different mindset for you to look at all the costs that are engaged that encompass your cost of risk. Then we're going to conclude with just a couple timely topics, a couple timely coverages that are very, very relevant for today. And then the thing that's near and dear to, I know, every nonprofit is, how do you ensure the special event? How do you ensure that fun thing that you want to do that raises a lot of money for you, but typically creates a whole bunch of risk issues or insurance issues? So that's where we're going to be going today. And again, I welcome any interruptions. So let's start high level, big picture. It's all about risk. When I talk about risk, I'm talking about business risk. The pure risk, should we operate that program? Should we go down that avenue to serve that constituency? I'm talking about financial risk, and I'm talking about legal risk. All of those things come together. And what we want to do today is we want to talk about some intentional behavior that you can do, you can control to drive the resultant cost of insurance. So managing risk best practices. Risk management, first of all, comes from the top. So the philosophy, I've worked with many, many organizations over the years, and it is very heart-pulling to work with an operational person that does not have the support of the board, of the chairman, of the executive director to look at things from a risk perspective. If you are that board, if you are that executive director, that chair, it is important for you to verbalize and embrace the concept of risk management and let folks know downstream from you the importance of this. And hopefully you take something away from this seminar that gives you some of those tools. So risk management is really simple. Sounds like a complicated word, but it's the identification, evaluation, the prioritization of business risk. What do we see? What are we going to do with it? How are we going to handle it? There's insurable risk. Insurable risk is the simple things that are right in front of you. Your building, your cars, your delivery trucks, your workers' compensation obligations under the law. Those things that are clear and right in front of you, that you transfer that risk over to an insurance company for the trade-off of premium. A risk committee. A risk committee is a recommendation I have for all of my clients. A risk committee is basically a think tank. It is folks that you get in the room for an hour a month, an hour a week, whatever it is, and you're thinking about risk. Should we do it? Yeah, heck, we should do it. We want to do that operation. We want to expand to that audience. We want to run that program. We want to rent that bus. So looking at those things, but looking at them from a perspective of the risk. How does it add risk to the organization? Is that an insurable risk? That risk committee should include executives. It should include operational people. It should include finance. It should include board. It should include legal. It should include employees. So all aspects of the organization, because risk, again, starts at the top and works its way down. One of the things that comes out of a risk committee a lot of times is the management of policies and procedures. Your policies and procedures are your written documentation. You've probably got 90% of what you need out there from a risk management standpoint. It's just a matter of looking at those policies and procedures as not the pain in the neck obligation that I've got to get this filed, or I have to have this in, or I've got to file this with the organization, or I've got to include this in my grant. But how are you going to live those policies and procedures? How do those policies and procedures assure your organizational values are delivered to all? From a risk management standpoint, those policies and procedures are your key to the defense of when something goes wrong. They are the key for you to carry into court and say, we had a policy and procedure for hiring and firing and discrimination. And we adhered to it, and we were consistent about it. And so we've done our best. We put it in place. We identified the risk. We created parameters around the edges of it so we could manage it to assure that it matched up with the values of our organization. And we were consistent about its enforcement and deployment. Those are really the very, very key strengths for when you do go astray, when you do have the claim, the suit, and it allows you to defend that suit successfully. You're going to have the cost of the suit. You're going to have the irritation of the suit, but you're going to be able to successfully defend that suit. And that's the key, is to end up on the other side successfully defending the suit and not having it stick to the organization. So speaking of sticking to the organization, one of the strategies of risk management is the transfer of risk. Okay, we want to take that on. Okay, we need to add a 15-passenger bus to our programming. Should we go out and buy one? Should we accept a donation from the local organization that's given us their used one? It just needs a little bit of paint and a tune-up. Or should we transfer that risk? Is it cheaper for us? Is it simpler? Do we not have to hire drivers if we rent the bus from somebody or lease the bus, get a bus service to provide our transportation? That's probably one of the most common risk transfers that I see nonprofits do is the transportation exposure. The transportation exposure is huge. It has regulatory issues. It has driver training issues. It has employee issues. You've got to have two people on the bus, an observer, a driver, etc. So that is an example of where you look at it and say, I don't want to take all that on. I want to deliver the service. I want to provide this. It's critical to our programming, but let's farm that out. Let's transfer that risk. So we call that transferring or the use of subcontractors. It's very important that when you do that to solidify that transfer is you want to have a contract in place. And part of that contract is the insurance provided by the subcontractor. That insurance needs to be evidenced on a certificate of insurance. And the most important thing is that it lists your organization as an additional insured party on that policy. Additional insured, I could spend 2 days talking about the ramifications and the complexities of it. It's really quite simple though. What additional insured does is when you ask the bus company to name your organization as an additional insured, that is causing their policy to respond and defend your organization if they're negligent. So they did something wrong. They dropped the child off at the wrong location. They didn't maintain the bus in a safe way and somebody was injured on the 50-year-old seats in the bus. Whatever it is, if it was their negligence, both parties are going to get sued. Both parties are going to receive suit papers and need to defend themselves. But the difference is that the bus company's insurance is going to reach over and defend your organization and take your organization with them for the defense in court. Without that, without the additional insured provision, your insurance is going to have to get involved. Your insurance is going to have to incur legal defense costs in order to defend you and say, hey, it wasn't us. We didn't maintain the seats. Hey, it wasn't us. We didn't train the drivers. So what this is, it's a layer to isolate your insurance, because as we're going to talk about here momentarily is you want to keep your experience as clean as you possibly can. That's the key. So importance of contracts within that defines the roles. Hey, you're in charge of picking up the kids, not us. You're in charge of bringing them to the door, and we pick the kids and we take over at that point. Defines responsibilities. And again, it also defines how the insurance is going to respond. So that's kind of some of the framework of that, of transferring the risk and avoiding the risk by transferring it to others. So let's now move over into the specifics about, okay, I've got insurance. What should I have? How much does it cost? Is this right? Well, there's only one way to find out whether it's right, and that is to get a perspective on the marketplace or shopping. You want to shop the insurance. Now, when I say shop, I don't necessarily mean go out online and find 15 different portals and send your needs out to everybody. That's not the way to do it. As a matter of fact, it's self-defeating, because there are only so many insurance companies out there that insure nonprofit operations. And if they receive the submission in too many times, if they see your account come across their desk this year, next year, the following year, and they don't win, they're all human beings. They're in the business of selling the insurance. And so your file's not going to get the highest level of attention. And so you want to be very strategic in how you shop. And let's talk about a couple of those things. First, are you getting the right attention from your broker? Your broker relationship is critical here. You're going to hear that theme throughout what I say. That's my role. I represent the interest of my clients as a broker out to the marketplace. So it's my job to translate that over to my client. It's my job to show my client that, hey, I've gone out to these 5 insurance companies, and these are the 2 that ended up at the finish line. And here's why we ought to go with 1 or number 2. So that occurs usually through what I call an annual review, where I'm meeting with the client. Sometimes that's by video, sometimes that's by phone, sometimes that's by letter, sometimes that's in front of their board on a Tuesday night at 7 o'clock. So the first question to ask is, are you getting the right attention from your broker? Are they responsive to your calls? Are they giving you guidance when it becomes claim time? Many brokers have pulled back from their involvement in claims. We don't get involved in the ticky-tack of the reporting of the claim. the details of calling the adjuster or calling the body shop. Is the car done? Can I pick it up? That type of stuff. But what we get involved in is the advocacy of it. Understanding, helping you understand the legal process, not being the lawyer, but helping you understand what you should expect next. Understand, where is this going to go? Understand that this is a 1-month process, or this lawsuit's going to be a 2-year process. So put on your seatbelt and get ready for it so that you can view it in perspective and communicate that to your board. How's your broker paid? Most brokers, like myself, are paid on a commission. We're paid on a commission that's built within the policy premium. That commission can range from anywhere from 5% to as much as 20%. Your property insurance pays the broker a higher commission, probably in the 20% range, where your workers' compensation is paying the broker probably something more in the 5% range. So on average, your broker's making about 10% commission. That's nothing I hide. That's nothing I'm not ashamed to put out there. And because everybody gets paid for what they do. And so if I'm not earning what I'm getting paid from my client, I expect my client to challenge me and say, hey, you know what? I don't think I'm getting my worth from you. And you should be doing the same thing. How often should you shop? Typically, we shop our clients on a 3-year cycle. And I say typically because there are variations to that. If you've got a significant change in your operations, you've added locations, you've added programming, that makes the complexity of your organization a little bit different. Maybe carrier A that you're with liked or disliked with that type of programming. And maybe it's time to move to a different carrier that has a different appetite. So changes in your operation drive the need. Changes in your operations drive the need. The other is economic events. Economic events is what drives pricing. When we have COVID, when we have a recession, when we have high inflation, those are things that drive the pricing of insurance from the highest of level, what we call the reinsurance level of insurance. The other thing that drives this is natural catastrophes. Last year and the year before were huge natural catastrophe issues for the insurance industry. Not so much here in the Northeast, but the wildfires and the floods have been dramatic, and they drain capital out of the industry. And then the industry as a whole raises pricing up. The insurance industry runs on about a 5 to 7 year pricing cycle. We are coming off of a peak. We're coming off of a peak where prices were rising in the 10 to 20% range solidly for the last 5 years. I'm now delivering price increases or renewal changes to my clients that are probably more in the 3 to 7% range, more in line with, hey, inflation's going up, the cost of construction is going up, the cost to repair a car is going up, the cost for medical treatment for the injured worker is going up. So the premium cost needs to go with that, not more than it, but with that. Do I see us heading into a valley? I unfortunately don't see us heading into a valley that we would normally have, because I'm concerned that we're going to have a lot of unforeseen and unpredicted impacts of COVID on the industry. So I don't see us going into a price cutting cycle where prices drop dramatically, and we can take advantage of that by remarketing our clients at that time. Should you use your existing broker, or should you go out to multiple brokers? Well, I think that comes back to the first question I asked. What's your relationship with your broker? Are you getting the attention that you need? And if the answer to that is, you know what, I am getting it. I trust that relationship. It's a valued relationship. It also happens to be a $5,000 sponsor for our golf outing. So if that's the case, then these are all challenges that you should be pushing back to the broker and enhancing your relationship. If that's not the case, and you're not getting that level of service, that level of expertise, the person just doesn't understand what you do, or you don't think they understand what you do, then yes, maybe it's time to bring in another broker. It's not time to bring in 5 brokers. It's not time to flood the market with applications, because as I mentioned earlier, that could be a self-defeating process if you get too much of you out in the insurance marketplace. It's not that big of an industry. And if an underwriter gets a submission in from agent A for your needs, and they get the same submission in from agent B, where do you think that submission is going to go? it's going to go aside. And they're going to work on something today that they think that they can win, that they can engage with. When they see that come in like that, then they're going to say, you know what, this is just, they're trying to get a price out of me. And this is going to take me hours and hours and hours to put together a price, and I'm not going to win. So it's not going to get your best test of the marketplace. So how do you go about that? Well, you need to start with putting out specs so that everybody is working on the same thing. When I say specs, I don't mean a 25-page RFP. What I mean is that you've worked to figure out exactly what is your exposures go forward. And the exposures of how your insurance is rated works off of things like your payroll level. Is it going up? Has it gone down? Your revenues. Has your program revenues increased or has it decreased? Your enrollment, your number of vehicles that you have, your number of locations that you have. Making sure that everybody that's out there working the game for you is doing it with the same set of facts. Because if you've got one broker working off of sales projections of 2 million or revenue projection of 2, and one working off of 1 million from last year's budget, you're going to get different answers. And most of those policies are auditable, so they're all going to come out in the wash. So you don't want to go with the one that's using the lower base, because you're going to get caught on the back end, and it's all going to end up about the same. So that's managing the insurance carriers. More is not necessarily better. And then claims. As part of your insurance submission to go out to the marketplace, one of the things that we as a broker have to put into that is, hey, what's their experience been like? Do they have a lot of auto claims? Have they had a whole bunch of water claims to their property that's got a leaky roof and they haven't had the capital to improve the building? And it's going to continue happening and happening and happening. Do they have a lot of workers' compensation claims? Do they not have training, safety procedures in place to prevent that from happening? So all of those things go into a document called your loss runs. Your loss runs are a piece of paper that comes directly from the insurance company that shows claim by claim by claim by claim. You can request that directly from your insurance company. In your policy will be an email address directly to the insurance company, or you can ask for that from your broker. In the brokerage world, when a client asks me for loss runs, it typically means that, hey, they're out shopping. And so it typically is a stand-up wake-up call that says, hey, I might be missing the mark here. I'm not giving them enough attention or resources or answers. So the pure fact of asking your broker, hey, send me over my loss runs, will usually be a followed up with, well, what's the problem? Or what have I missed here? Or what is it I'm not delivering to you? So purely asking for the loss runs is a good way to kind of give your broker a wake-up call. I would suggest the other alternative is that you make ordering your loss runs part of your annual process, because as we talk about here, talking to your constituencies, your audiences, having your loss runs and understanding those details that go into a claim and what the insurance company is paying on your behalf is an important part of those within your organization to better understand this trade-off of managing risk versus paying premiums. So let's move over to priorities. It's funny, not funny, haha funny, professionally funny, that a lot of the times when I work with a new nonprofit in particular is that I get a phone call that says, hey, we need that D&O insurance thing because we're starting up. Or I'm looking for a new board member and the board member wants to make sure I've got that D&O insurance. Well, first of all, let's define that. D&O is directors and officers. Directors and officers is coverage that protects the organization for an outside party suing the organization for mismanagement. That's the non-legal term. In other words, you screwed up. You didn't invest the funds right. You applied for a grant that said you want to do something that's blue, but then you went and spent the money on something that was red. And the donor says, wait a minute, I gave you money to do blue, but you guys went and did red. I'm going to sue you because you've misused my funds. That's just a couple examples of D&O. D&O is very important. Don't get me wrong, but D&O isn't the place to start. It's not the place to start because, one, it's not the lion's share of your premium. The lion's share of your premium is going to come from the bricks and mortar type things, your general liability, your property insurance, your workers' compensation. Those three things probably make up 80 to maybe even 90% of your entire insurance spend. So let's focus on those. Let's focus on making sure that your general liability is based on and rated off of the right exposures, the right size programming, the right number of locations, the right limit of liability. Let's make sure that your property insurance is based off the right value for the building, that you've done a replacement cost estimator, that you've included all of your inventory, that you haven't forgotten about all the stuff that you've got in a shed off-site that you only use once a year for certain programming. Let's look at the workers' compensation. Let's manage the loss runs. Let's look at what's happening. Do we have a history? Oh my golly, we keep having somebody get injured at that site. We keep having somebody get injured in that kitchen doing this function of food preparation. So those are the areas where I would emphasize and put your priority, because those are the drivers of your premium. The next one in priority is cyber. Cyber is becoming huge. We see it on the news almost every day. You see it in newsletters, you see it in risk management, you see it in trade publications. And we'll talk about that in a little bit. So cyber is definitely on the list of priorities higher up, and it's not expensive. It's not expensive. I'll talk about that a little bit later. Automobile is clearly, if you don't have any autos, scratch it off the list. If you've got some autos, whether it's an executive's vehicle, or you've got 3 buses, or you got a van that drives material around and delivers food, yes, auto is critical and kind of in that middle ground. And D&O is then, as we mentioned, the directors and officers, and also within D&O is employment practices liability. The two go hand in hand, are usually in the same policy, not always. But employment practices is hiring, firing, discrimination, things that you do wrong in the human HR part of your business. And that, unfortunately, that trend is increasing, and I'll talk about that in a little bit. Last is professional liability. Most nonprofits do not have a professional liability exposure, or errors and omissions, as it's sometimes called. That is when you're delivering, say, medical services. So there are a lot of nonprofits that deliver medical services. So that's your malpractice. So Nancy, thanks. So let's talk kind of big picture about total cost of risk. It sounds like a very fancy philosophy or theory, but it's really quite basic. Your cost of your insurance is not the monthly installment. It is not the premiums that you're told, here's your annual quote for this coming year. It goes well beyond that. That is a component, largest component, easiest to measure and see component, but there are a number of other things that go into the total cost of risk that might affect your decision-making in how you buy that insurance. So we start with premiums. Second is deductibles. Deductible is what you're going to pay at the time of the loss. So that might be 1,000, might be 5,000, might be 10,000. It might be as much as 25,000. The higher deductible that you assume, the lower the premium is. But then you got to wait, because you could have that claim tomorrow, and then do you have the cash flow to fund that deductible to go get the car out of the body shop if it's got a really fat deductible? Do you have the money to fund and pay the contractor the deposit to get the reconstruction of your kitchen done, because they want to start tomorrow and they need a deposit? So there's a trade-off, but you've got to consider that deductible. That's kind of the unincurred but expected expense that's got to go into your income statement as an operating expense. The known uninsured exposure. That's the decision you decide, hey, I don't want to insure that. I got an old shed in the backyard. We keep a bunch of equipment in it that we rarely use. I don't want to insure it. Don't insure it. If it burns down, I lose it. But I'm making the conscious decision. I don't want to spend money on that. That's things like old buildings, obsolete equipment, and such. Then we get into the unknown, uninsured exposure. Those are the surprises. Those are, oh my golly, where did that come from? And in 30 years of doing this, I'm surprised every day at surprises. And that's kind of why you have the insurance there, is for those things that you couldn't manage, you couldn't control, you couldn't train your way, you couldn't subcontract your way out of. Time is money. Why do you want to avoid lawsuits if you've got this nice insurance thing that's going to take care of it? because it's going to eat your time up. It's going to mean responding. It's going to mean responding, going to depositions. It's going to mean responding and going to court. It's going to mean a whole lot of phone calls. So you have to also look at it at the time investment when something does go wrong, that's part of your total cost of risk. The deductible trade-off we talked about. Payment terms. Payment terms have become huge. Most insurance companies are really pushing towards EFT or ACH, some type of automatic transfer. One, because it lessens their operating costs because we're not chasing non-payment notices that go out because somebody forgot to mail a check. But it gets them their money consistently, and they have been doing a really good job over the past several years of transferring that onto savings. So much so that it can be as much as 5% savings if you either pay up front or you pay on a monthly transfer that's automatic to a bank account or to a credit card. So I really encourage you to look at that. A lot of people have anxiety over the ACH and giving, the authorization to withdraw your funds, but this is a direct dollar trade-off. Cash flow, we talked a little bit about, and keeping your record clean, we talked about a little bit also. So as I mentioned, one of the unique things I know about managing a nonprofit and the insurance issues is you've got different audiences, and those different audiences have different needs. They have different wants. They have different understanding levels. And you've got a different communication level of detail that you want to communicate to the three different constituencies. So let's start with the board. What's the board interested in? Well, the board's interested in adequacy. Do you have the right coverage? And then is that right coverage priced right? Not high, not low, but right. And so the board is really interested in that. Hey, what have you done with the broker? What have you done to shop this? What have you done? Hey, did we shop it this year or did we shop it last year? Why did we not do it? Why did we do it? So kind of some of those market decisions that drive that is what you want to be communicating to the board. Management, leadership, your executive team. We bring it down one more level. We start to bring in the concept of total cost of risk. Hey guys, in order to manage our insurance costs this year, we have increased our deductible from $5,000 to $10,000. So folks, that means that if we have something go wrong, if we leave the door open and the place gets robbed tonight, that's going to cost us $10,000, not just $5,000. So that becomes, you start to communicate that total cost of risk component to your management, to your leadership team, so that they can understand it and they can make operating decisions accordingly. More importantly is, those are the people in the trenches. Those are the best practices people. Those are the ones that are concerned about safety, subcontractors, training, policies and procedures being in place. They've got to understand that, no, the fact that you need that policy and procedure for Thursday's board meeting is not just a pain in the neck. It's a critical component to us being able to defend ourselves, which has a large deductible and a whole bunch of hassles. I think you're starting to get it. I hope you are. And then the last group is your employees. Not as tactile, but again, probably the biggest thing is that trade-off between, hey, worker that I walk through the kitchen, I say, do you have your goggles on? Do you have your gloves on? Are you working safely? Are you driving safely? Are you talking on your cell phone while you're driving the company van? Those are the very tactile things that it's your job to convey to those folks. That trade-off, it matters. It matters if you have that intersectional accident because you were on your phone, non-hands-free, talking to whomever, and you had that accident. Now I've got a large deductible. Now I've got a lawsuit involved. So that trade-off level is very important at the employee level. And that's where that risk committee comes back into play. When you have a couple key people, and you know who those key people are, they can either be agitators or they can be champions. But you put those key people on that risk management committee, now you got an advocate. You've got an advocate for risk. You've got an advocate for that total cost of risk trade-off. And again, those are the people that are really implementing the policies and procedures. They're not the ones writing them. They're the ones implementing them. So they need to understand, again, that trade-off. So a couple hot topics, hot coverages. These are the cyber is relatively new. When I say new, in the last 5 to 10 years, the cost of cyber has been increasing dramatically. Why? Because the claims have been increasing dramatically, like nothing I've seen in 30 years. The frequency of cyber-related claims is just scary. You see it on the news. The large organizations that are getting hit, they make the news. It's the smaller organizations that are getting hit. They don't make the news, but they're happening. Where do you get the coverage, and what should you be spending for it? Well, most insurance companies have evolved and added a small form of cyber coverage into your package policy. Your package policy is that policy that covers your building, your property, your inventory, your store, your warehouse, and also your general liability. It's called a package because exactly that. We package together multiple things. In there is typically some broad endorsements. And in those broadening endorsements, many insurance companies have rolled out and automatically included some cyber coverage in there. I call them baby limits, 25,000, 50,000. Those are baby limits. Okay, glad we've got it. Glad we're only spending $250 for it. But is it really going to cover the catastrophic exposure if we have a data purge and we lose our database of all of our donors out to somebody else and we now have a privacy violation? Is it really going to address the need if we've got the black screen of death and our server is shut down and I got to spend hours and days to rebuild our server? Is it really going to pay if I get that black screen of death that says $75,000 of Bitcoin, or I'm going to melt everything I took off of your server last night? No, is the short answer. It's good. It's the baseline. It's the, I don't want to spend a lot more money on this, but I at least want to know I've got something. It's the head nod to your board that says, yes, we've got cyber coverage. Not great, but we've at least got it. So look at your package policy. Challenge your broker to add it in if it's not already added in. Where should you be going? You should be going to a standalone policy, meaning a policy, one policy, it's got a date on it, a premium, an insurance company, a standalone policy separate for cyber, much more robust. What are you going to pay for that? You're going to probably pay something in the range of $1,000 to $5,000, depending on the size of your organization. Some of my larger clients that are in the 10, 20, $30 million of sales or revenue are probably spending more in the $10,000 range. So this coverage is probably going to be in that $1,000, $2,000, $3,000 range for you. So I would definitely recommend seeking out a standalone cyber coverage. What is that standalone going to cover you for? It's going to cover you for extortion. Extortion is the hot one. Extortion is the $5,000 of Bitcoins by 10 o'clock this morning, or we're going to melt everything you have. A standalone cyber coverage actually pays that ransom. It's not the insurance company is going to fight it and say, oh, well, we want to think about whether we should pay the thief for this, and let's think about it for a couple of days, and we'll think about whether we want to fight this thing because theory is that, oh, we shouldn't give in to them. No, ransom coverage is explicitly in the policy. You're going to have a deductible. You're going to have a little bit of pain. Might be typically $2,500, but it's going to pay it. Now, you can't just run off and pay it in Bitcoins at 10 o'clock in the morning. You need to file a claim quickly that day with the insurance company, get them involved, get the police involved, other authorities, and the insurance company will manage that process for you. But there's going to be money there to actually pay the ransom. So you may go home with your head between your tail between your legs that you get suckered into having to pay a ransom, but you got your system back. The next one is social engineering, otherwise commonly known as phishing, spear phishing, CEO phishing. That is they hacked your system to find out about your information. They hacked your system to get your email, to get somebody else's email. They didn't hack your system to steal your bank account code, your password, your log on, and things like that. But what they did was they hacked your system so that they can learn enough about you and get the name of the CEO, the CFO, the treasurer, the bookkeeper, the payables person, so that they can create an artificial email that goes between the payable person to the CEO that says, hey, change the routing number for that payables vendor that we regularly pay to every month. But hey, apparently they changed banks and we need to send our monthly payment to this new ABA routing number and bank account number. Or hey, for some reason, this vendor is contacting us because we must not have paid them last month's bill. Could you please wire that over to them real quick? So, and guess what? All of those instructions were false. All those instructions were artificially created because they learned enough about your organization that they were able to create an email within the organization that looked like it came from the CEO at 4 o'clock on a Friday afternoon, that looked like it came from the CFO while he was on a plane for 8 hours. And because they looked at his schedule to determine he would be on a plane for 8 hours unreachable, and the CEO or the CFO suddenly sends the controller an email that says, wire this money, it's urgent. And the controller's like, what do? I'm going to do it. I got an email from my CFO asking me to do it. Those are all social engineering. Nobody put a gun to your head. Nobody broke open the back door. No alarm bells went off. You sent that money to the thief voluntarily, theoretically voluntarily. That's social engineering. That's where I'm seeing a huge, huge uptake. And it's not just happening to small organizations, and it's not happening to the unsophisticated. It's happening to the very sophisticated. My largest one so far this year is about $150,000 for a $30 million manufacturer in the Providence area. And what happened was it was a human breakdown, and it was probably caused by COVID, working at home, where two payables people that normally sit across from each other and would have said, hey, Mary, I got an email here from supplier ABC and they say change the bank number. And the two of them probably would have looked at each other and said, wait a minute, that doesn't make sense. Let me call them. Let me call and confirm. But because these two people were working from home, there was a procedure that says that they should have called them, and human error came in and they didn't call them, and it broke down. And they wired $150,000 to an account overseas. Gone. So again, covered by social engineering. Employment practices is the next area. As I mentioned, employment practices is usually associated with and connected with and built in with your D&O. And so that is something very important. Employment is, again, the discrimination in hiring, firing, promotion, pay rate. It is becoming more and more apparent as we as a society become more socially conscious of differences amongst each other, whether it is age, sex, gender, you name it. So our societal changes are driving this. The other area specifically, you may have heard the term hostile work environment. Hostile work environment means we've got a really bad situation here and somebody is behaving, talking unprofessionally and inappropriately. And I'm tired of coming to work and having to listen to it. I'm tired of the jokes. I'm tired of the bad jokes. I don't find them funny. I find them offensive. We call that hostile work environment. And those types of claims are becoming compensable. And they are very hard to defend because usually it happened. The defense is that we've got policies and procedures in place. The defense, the successful defense, is that we took action about it. That when it was reported to an upper level person, we gave a damn. We acted. We convened an investigation. We reported it to HR. We had a counseling session with employees. We created a corrective action program with that employee. We took action. We can't stop that person from being inappropriate, maybe. And if we can't, maybe we should be getting rid of that person. But the most important thing is that we as organizations followed our policies and procedures and we took action. That's how you successfully defend yourself. You may not win the case, but you're going to show yourself that you took action, you respected that person's rights, and you're going to minimize your damage accordingly. The biggest issue that we have is failure to act, failure to investigate, failure to have a process in place, failure to have in the employee manual a complaint portal. This is where I'm going to complain to, whether it goes to the head of HR, or a lot of the times it goes to somebody on the board. Typically the audit committee or the executive committee of the board becomes that kind of portal where the employee feels that, hey, you know what? if I tell this to my boss, they're going to retaliate. But if I tell it to the audit committee of the board ought to take this thing a little bit differently. So very important to have that in place. As we face what everybody's calling the great resignation, I'm starting to see what I call the great rethinking, the great kind of, hey man, I quit my job, but did I quit my job or did I leave my job because I was irritated, agitated, offended, etc.? Maybe I'm going to go back now and sue my organization. So I call it the great rethinking, and we're starting to unfortunately see a little bit of a trend there. Moving over to COVID. COVID impact on your business. First of all, before COVID even happened, your policies, 99.9% of them had what we call a viral exclusion. The viruses, we didn't use the term COVID because it didn't exist yet. Viruses were excluded. We're seeing carriers even strengthen those more. So the long and the short of it is COVID is not covered. COVID is not ramifications. There's a couple aspects of it. Workers' compensation, it's very difficult to say I caught COVID at work and hold the employer compensable. Early on in COVID, we did see a trend towards that being covered for things, particularly in the hospitality industry, where a lot of people were continue to be subjected to it and say, hey, I wouldn't have gotten it if I wasn't out here waiting the tables. So yes, it is compensable over on the workers' compensation side in some cases. Event cancellation. The event gets canceled because of COVID. We'll talk about that in a moment in special events. And business interruption. I had a lot of organizations that shut down their facilities, manufacturing plants that just shut it down because the government said you had to shut it down. Those, again, are not compensable. They're starting to work their way through the court system, but most court determinations right now are continuing to uphold the exclusion within the policy. So the problem is that without a direct physical loss to your facility, typically a government declared shutdown is not something that's compensable. So let's talk about special events, and then we're going to wrap up with how do we get started. Special events are your bread and butter. I know it's very relevant to the nonprofit sector, especially as we head into post-COVID. Everybody wants to do it. You got 3 years worth of golf outings you didn't have, and in turn, unfortunately, because of some of the COVID issues and some market issues, the cost of special events insurance is going up moderately, 10, 20%, not 50%. In particular, liquor liability is becoming more expensive and more challenging to get. Challenging meaning you've got to have things in place. You've got to have those people that have had tips training for serving of alcohol. You've got to have a security plan in place. So liquor liability in particular is a little bit tighter in underwriting, but it is definitely going up in cost. So if you're adding liquor or have liquor involved in your special event, you need to take that in mind, that the cost of that is going to be a larger operational expense for that event. Weather cancellation, weather insurance has always been out there. Frankly, I don't have many clients that buy it because weather insurance typically costs you about 10% of the revenues, meaning you're going to hold the event on Saturday, you expect to make $500,000. We can insure if it rains cats and dogs and you can't have the event, we can insure that $500,000 for you, but we're going to take $50,000 of the $500 to insure it. That's not a really great trade-off. That's not a great trade-off. What I frankly find is most of my clients say, hey, we've already gotten 90% of our donations in. People aren't going to ask us back for the registration fees. They're going to say, oh, that sucks that you couldn't pull your event off. Keep my money. Good luck. See you next year at the race, the run, the festival, the event, the fair, etc. So weather insurance is out there. If you have something high ticket price that's truly weather critical, we can get it for you. But just recognize you're going to give up about 10% of what you earn on that event. COVID, we talked about that a little bit. Liquor liability, we talked a little bit about that. If you serve, you're at risk. How do you solve that? You buy a one-day liquor liability policy, or also you hire an insured caterer. So don't do the hey, we're all bringing our bottles behind the bar and Joe's going to be the bartender. No. Hire a caterer that is a licensed caterer, that's got a liquor license, that's got liquor liability insurance, that has employees that are trained for tips training. Tips training is like safe serve. Tips training is, hey, are you checking IDs, number one? And number two, are you serving to intoxicated people or are you cutting them off? So managing the risk directly pays off. Does your current policy cover special events? Likely not. If it's a small thing, yeah, a golf outing, a dinner at the local country club, absolutely. But you need to look in the exclusions, the higher risk events, the higher attendance events. I'm talking over 500. There's typically an exclusion in your policy that says events over 500 folks is excluded. If it's excluded, we buy a one-day policy. That's the way to solve it. Simple. So wrapping up here, where do we start? Well, I hope that one theme came through, and that is ask your broker. Your broker relationship is critical. I'm not suggesting that you all should go back to your desk, back to your office today and fire your broker because you're unhappy. No, start a dialogue. Ask a question. Pose a question. Ask about the renewal cycle. Start a dialogue. And the first start of that dialogue is an inventory of your policies. Ask your broker for a 1-page, 2-page summary of what are the 5 policies I've got. Maybe they renew different times of the year. You lose track of them. Put them all on one piece of paper. What am I got? What is my total spending? And so you can see it all in front of you. For my clients, I use a 1-page Excel spreadsheet that gives them literally all of their policies and the key details of it, but then also multi-years. So they can see, oh, we were spending $20,000 last year. Now we're spending 22. Now we're spending 28. Oh, we're spending 28 because we also increased our revenue. We added that programming. We added the delivery buses or delivery vans. So you can see it, and it makes logical sense if you are tracking the exposures along with the premiums. That's the type of information, again, that's critical to your board. Have the broker conversation. Discuss the shopping strategy. Should we shop broker? Your broker ought to be able to say to you, you know what? Philadelphia Insurance Company is raising their prices. I think I want to take you out to Selective, or I think I want to take you out to Arbella, or I found a program with Great American that's specializing in this. Have that dialogue and trust what you get. If you don't trust, then look for a different broker. But if you have that trust, move forward with them. Poll the board. Sometimes that's dangerous because sometimes you get too many good ideas. But poll the board. Ask your board members, do you guys have an insurance broker relationship that we trust? Should I have a conversation with them? Because remember, once you've engaged that other broker who's the board member's friend or brother-in-law or fraternity brother, now there's an obligation. You're going to have to go with somebody. I call it, are you ready to fire your broker decision? Are you truly ready to fire your broker? Are you that dissatisfied that you're ready to fire your broker? If you're not ready to fire your broker that you're with now, then don't bring in another broker because you're going to have to make that decision. Go back to the broker and have this dialogue that we've talked about. 60 to 90 days is when you should be working on it. And be realistic. Be realistic. Be willing to implement best practices. Be willing to have an insurance company come out, do an inspection, meet with your people, make recommendations, and implement those. Those best practices are your way to manage risk. You manage risk away, then you manage premium away. And with that, I open it up to questions and answers.
Wow.
So feel free to unmute yourself if you have a question.
Am I muted? Am I muted?
Judy, you're unmuted. Did you want to ask a question?
I am. There I am. Hi. How do you do? Thank you for that. That was fabulous. Can you hear
Thanks,
me?
Judith. I can.
So you referred a lot of times to the at-risk committee. They said you said they're your agitators or your champions and so forth. Can you talk about the constitution of such a committee? Is that? Yeah.
Sure. First of all, reach out to your insurance carrier. Reach out to your carrier. If your organization is large enough, insurance companies have what we call loss control people. Loss control, I call them the hard hat people. They're the people that come out with the hard hat on and the name badge that says Philadelphia Insurance Company, whatever insurance company. They're the ones that do the inspection of your site. And they can be annoying because they can be the, oh, you need more fire extinguishers, or you need a handrail on that door. Those are all good things. I'm not minimizing those, but dig deeper. That's the person that can give you some resources, that can give you a template for an agenda, that can help you set that up. How often should we do it? Should we do it monthly? Should we do it quarterly? I would say start with quarterly, and then work your way towards whatever direction you need. So start with your insurance company. They can give you those resources to put together the framework of it. And take the aspects that we talked about here in this slide. What are the things that the committee should be talking about? They should be talking about the premium. They should be talking about policies and procedures. They should be talking about safety. They should be talking about future choices of operational things that are we going to be doing. In other words, if there's somebody on the board or in the executive team that's got this brainchild, you know what, next year I want to do that. I want to apply for that grant. Let's throw that over to the risk committee and have them chew it around a little bit. Okay, in order to do that grant, in order to deliver that program, we got to get a bus. We got to add another facility. We got to add 2 more people. We got to do something different. We got to hold a party that's got liquor involved. So that's the committee that should not, the board and the vision and the operational people are the pie in the sky. Let's do it. This is great. Mission fits our culture, etc. The risk committee are the ones that say, hey, let's make sure we got all of our ducks in a row.
Thank you so much. I have to go. I'm so sorry.
Yep.
Thank you. Bye, everyone.
Bye-bye. Thanks for coming. I know we had a bunch of people jump off, but I'm going to stop the recording. But Kelly and Jenny, if you want to ask questions, you can still do that. Let me just stop the recording and then you can.